Welcome everyone. Before we start, the ground rules, and please hold me to them. Today is education only. Nothing you hear is investment advice. I am not recommending that anyone open a margin account, trade with borrowed money, or risk any particular amount. Every number today is a made-up example used to teach how the rules work. And one plain warning up front: trading with borrowed money is risky, and it is possible to lose more than you put in. Whatever you hear today, check it against your own broker's website before you rely on it. Now, 2 quick definitions so we all start in the same place. A cash account is a trading account where you can only spend money you actually have. A margin account is different. The broker attaches a borrowing line to it, so you can temporarily control more stock than your own cash could buy. That borrowing is called leverage. Here is why we are talking about this now. In June 2026, the rule that controlled day trading in the United States for 25 years was thrown out and replaced. The old rule said you needed $25,000 to day trade freely. The new rule replaces that with a $2,000 line, and that line behaves in a way that surprises people. Cross it from above, and your borrowing power does not shrink a little. It collapses all at once. By the end of this session, you will understand exactly why and how the math of an ordinary trading day interacts with that line. Let's start with what changed. A quick history lesson first, because most of what you will find online is now out of date. For 25 years, there was something called the pattern day trader rule. A day trade means buying a stock and selling that same stock on the same day. Under the old rule, if you made 4 or more day trades within 5 business days in a margin account, you got flagged, and once flagged you needed at least $25,000 in the account to keep day trading. Below $25,000, you were limited to about 3 day trades a week. On June 4, 2026, that entire rule was deleted. Regulators approved a replacement, so there is no more flag, no more counting trades, and no more $25,000 requirement. Here is what runs the show now, on the right side of the slide. The key number is $2,000 of equity. Equity just means your own money, what you would have left if you sold everything and paid back anything you borrowed. If your equity is at or above $2,000, the broker can lend you up to 4 times your available money for trades you close the same day. If your equity slips below $2,000, that lending drops to 1 times, which means no borrowing at all, until your equity comes back up. And instead of counting your trades, the broker now watches your borrowing in real time. Borrow more than allowed, fail to fix it that day, and do it repeatedly, and the account can be restricted for 90 days. One caution: brokers have until October 2027 to finish rolling this out, so details differ from firm to firm, and everyone should check their own. Now, that $2,000 line sounds like a small technical detail. The next slide shows you why it is anything but. Let's read this chart together, because it is the most important picture of the day. Along the bottom is equity, your own money, in an example account with no positions open. Up the side is buying power, which means the total dollar amount of stock the broker will let you control for the day. Start at the right edge. With $3,000 of your own money, 4 times leverage gives you $12,000 of buying power. At $2,500, you get $10,000. At exactly $2,000, you get $8,000. Now watch what happens one step to the left. At $1,999, buying power is just $1,999. Your own money dropped by a single dollar, and about $6,000 of buying power disappeared with it. Here is the idea to hold on to. This is not a dimmer switch. It is a light switch. Your borrowing does not fade gradually as your account shrinks. It is fully on above the line and fully off below it, and the rule gives you no warning zone in between. Traders who learned under the old system remember a hard gate at $25,000. The gate did not go away. It moved down to $2,000, which means it now sits very close to where many newer traders' accounts actually live. That $1 cliff is dramatic on a chart, but let's make it practical. What does falling over it actually cost a real account, in dollars and in time? Let's walk through it. Follow the story across the top of the slide. Our example account starts with $2,500 of its own money. Above the line, 4 times leverage means about $10,000 of buying power. Now the account hits a rough stretch and loses $501. In percentage terms, that is a 20% loss. Painful, but traders survive 20% losses all the time, and normally losing 20% of your money just means you trade about 20% smaller afterward. Not here. Equity is now $1,999, $1 below the floor, so buying power falls to $1,999. Read the 3 boxes together. The account lost 20% of its money, but 80% of its buying power. And the climb back is slower than the fall. Below the line you can still trade, just with no borrowing. If your trade size depends on your buying power, you are now trading at about 1/4 of your old size. Same skills, same strategy, 1/4 the size, which means winning back that $501 takes roughly 4 times as many trading days as it took to lose it. Picture a boxer who is still allowed in the ring, but with one hand tied behind his back. His talent did not change. His ability to use it did. So if the $2,000 line is the real hazard, then the money you can afford to lose is not your whole account. It is only the part sitting above the line. That idea gets its own slide, because it changes everything about how trades get sized. Here is the mental shift that makes everything else today click. Stop thinking of the account balance as the bankroll. The real bankroll is the cushion. Equity minus $2,000. Why? Because that is the only money the account can lose before the borrowing shuts off. Pilots think this way about altitude. A pilot does not care how high the plane is above sea level. They care how high it is above the ground, because the ground is what ends the flight. For a leveraged day trading account, $2,000 is the ground. Now look at the table with that in mind. An account with $2,500 has a cushion of just $500. Only 20% of that account is truly spendable before the floor. An account with $3,000 has a $1,000 cushion. An account with $5,000 has a $3,000 cushion. Notice the surprise hiding in those numbers. Going from $2,500 to $5,000 doubles the account, but it multiplies the real bankroll by 6. 2 accounts that look similar on a statement can be completely different animals once you measure from the floor instead of from zero. Every sizing idea in the rest of this session is measured against the cushion, not the balance. But to size anything, we need a realistic picture of how a trader performs day to day, how often they win, how much a win pays, and how much a loss costs. That example profile is next. Here is the made-up trader we will study for the rest of the session, described by the 3 numbers on screen. First, they take 30 trades a day. Second, their win rate is 65%, meaning out of every 100 trades, 65 make money and 35 lose money. Third, their profit factor is 1.3. Profit factor is simple. Add up every dollar the winning trades made, add up every dollar the losing trades lost, and divide. A profit factor of 1.3 means the winners brought in $1.30 for every $1 the losers gave back. One more piece of shorthand, the most useful letter in trading. RR is just the size of the average losing trade, in dollars. If the typical loser costs $25, then R is $25, and 2R means $50. We use R because it lets the same math work for any account size. Now watch what those 3 numbers force. Say the average loss is $25. Out of 100 trades, The 35 losers cost 35 times $25, which is $875. A profit factor of 1.3 means the 65 winners made 1.3 times that, about $1,138. Divide $1,138 by 65 winners, and the average winner is only about $17.50. There is the surprise. This trader wins often, but the average win is smaller than the average loss. Averaged across all 100 trades, they keep about $2.60 per trade, which over 30 trades is roughly $79 a day on our example numbers. A real edge, but a thin one. And one more surprise, even with the math in their favor, about 1 day in every 4 still ends in the red. A thin edge plus a 35% chance of losing any single trade guarantees one thing: losing streaks. Let's see exactly how often they show up. Every trade this person takes has a 35% chance of losing. Think of it like flipping a coin that is weighted in your favor. It still comes up tails 35 times out of 100, and sometimes tails shows up several times in a row. At 30 trades a day, a month of trading is about 600 flips of that coin. This chart shows the chance of hitting at least one run of consecutive losses somewhere in those 600 trades. Read it left to right. 4 losses in a row, more than 99%, basically guaranteed every month. 5 in a row, about 87% of months. 6 in a row, and this is the bar to remember, about 51%. A 6-loss streak is a coin flip. Every single month. Here is why that matters. A losing streak feels like proof that something is broken. The math says the opposite. For this profile, streaks arrive on schedule, like weather. They are not a sign the strategy failed. But, and this is the danger, a completely normal streak can still walk an account straight into the $2,000 floor if the trades are sized too big. So the real job of position sizing is this. Make sure a normal streak, landing on top of a normal rough patch, cannot reach the floor. Which raises a very practical question. How big does the cushion need to be, measured in losing trades, before touching the floor becomes rare instead of likely? The next slide gives you the actual odds. This slide answers the question with odds, like a weather forecast for the account. For the trader we just described, we asked, what is the chance the account ever touches the $2,000 floor? The answer depends on one thing: how many average losing trades the cushion can absorb. To make that concrete, if the cushion is $500 and the average loss is $25, the cushion is worth 20 losses. Now read the 4 cards. A cushion worth only 5 losses touches the floor about 1 time in 5. Terrible odds for something this important. A cushion worth 10 losses, about 1 in 24. 15 losses, about 1 in 120. And a cushion worth 20 losses, roughly 1 in 600. Notice the pattern. Every 5 extra losses of cushion makes the account about 5 times safer. Safety compounds fast, and so does danger in the other direction. Where do these numbers come from? Standard probability math, which we then double-checked by having a computer simulate 20,000 pretend trading careers with these exact statistics and counting how many hit the floor. The simulation agreed. 2 honest warnings, though. This math assumes every stop-loss fills at the planned price, and it assumes the trader's edge is real and stays real. Law of trading is messier on both counts. So treat 20 losses of cushion as the minimum for comfort, not a target to shave against. Now let's turn that table into a rule anyone can compute in 10 seconds before the market opens. Here it is, the one formula of the day, and let me repeat the framing first. This is the teaching framework we built from the math you just saw, not advice about what any individual should risk. The rule reads, maximum average loss per trade equals equity minus $2,000 divided by 20. In plain English, figure out the cushion, then never let a typical losing trade cost more than 1/20th of it. Why 20? Because the last slide showed that a cushion worth 20 losses only touches the floor about once in 600 tries, under ideal conditions. Walk the table with me. The $2,500 example account has a $500 cushion. $500 divided by 20 is $25. So in this framework, a typical loser should cost no more than $25. The $3,000 account, $1,000 cushion, $50 per trade. The $5,000 account, $3,000 cushion, $150 per trade. See how quickly the allowance grows as the account grows? That is the cushion effect from earlier doing the work. The rule has a second half on the right, the daily circuit breaker. A circuit breaker is just a personal quitting rule you set in advance. This one says, down 5 or on the day, meaning 5 average losses, and trading stops until tomorrow. On the example account, that is 5 times $25, or $125. The point of it, 5 losses is 1/4 of a 20-loss cushion, so even the worst single day can only spend 1/4 of the survival budget. 2 numbers, one before the open, and one during the day. Now let's stress test this framework against a very common style, the same share size on every trade. Many traders keep things simple. 100 shares on every single trade, in stocks priced between $2 and $10. It is a popular style because using the same size every time removes a decision in the heat of the moment. Let's push that style through our framework on the $2,500 example account, with one definition first. A stop, or stop loss, is the exit you choose before you enter. If the stock drops to that price, you sell immediately and take a small, planned loss. The distance between your entry price and your stop is how much you are risking on each share. Top row. 100 shares of a $2 to $10 stock is a position worth $200 to $1,000. On a $2,500 account, that is a small slice of the money per trade, and notice what that means. Borrowing is not the danger in this style. The stop is middle row. The framework allows a $25 average loss, and $25 spread across 100 shares is 25 cents per share. That 25 cents has to cover everything, including slippage, which means getting filled at a slightly worse price than you planned. Bottom row, and here is the catch. 25 cents is not the same everywhere. On a $2 stock, 25 cents is 12.5% of the price. Plenty of breathing room. On a $10 stock, 25 cents is only 2.5%, a very tight leash. So the honest educational takeaway, 100 shares everywhere fits this framework at $2,500, only if the stops truly stay inside 1/4. On the $8 to $10 names, where stops usually need more room, the arithmetic points to fewer shares there, or a bigger cushion first. Which brings us to the question everyone came in asking. The broker is offering 4 times leverage, so how much of it does a conservative framework actually use? Once an account is above $2,000, the screen will show up to 4 times buying power. So what does conservative look like? The framework's answer is on the banner. Even though 4x is offered, treat 2x as the ceiling, and let per trade risk, the number from our rule, decide the actual size. Think of buying power like the speed limit on an empty highway. The sign tells you what is allowed. It does not tell you what is wise. 3 reasons, 1 per card. First, using only half the offered leverage leaves room for real life. Orders that fill at worse prices, entries that were a little early, days when everything moves fast. Second, and this is the big one, every number today assumed the stop fills at its price. Cheap, fast-moving stocks get halted, meaning the exchange pauses trading when a stock moves too violently, and when trading resumes the price can reopen far past your stop. That jump is called a gap, and you are out at a much worse price than planned. A 30% gap through a stop on a $1,000 position is a $300 hit. In our example, that is 12 average losses gone in one shot, more than half of a 20-loss cushion, and no streak chart warns you first. Third, intraday leverage is a daytime privilege. Hold past the closing bell and a smaller overnight limit applies. The broker can demand money or sell positions, and overnight, the market can gap while you cannot act. And notice something from the worked example. For this style, leverage was never the first constraint anyway. The per-trade risk budget fills up long before the borrowing does. The 2x ceiling exists for the disasters the per-trade math cannot see. Let's land the whole session on one card you can keep. Everything today fits on this one card, and I will say it a final time. These are the rules of the framework we studied together, offered as education, not instructions for anyone's money. Rule 1. Know the cushion. Equity minus $2,000, recomputed every single morning, because yesterday's trading changed it. That number is the real bankroll. Rule 2. Keep the average losing trade at or under the cushion divided by 20. On the example account, that was $25. Rule 3. The total value of stock held at any one moment stays at or under 2 times equity, which in practice means 1 or 2 positions open, not 5. The 4x on the screen is a limit, not a suggestion. Rule 4. The daily circuit breaker. Down 5 average losses in a day, and the day is over. That caps any single session at a quarter of the cushion. Rule 5. If the cushion shrinks to fewer than 10 average losses, stand down. The odds table said a perfectly normal streak can reach the floor from there, so the framework says trade smaller or pause until the cushion is rebuilt. Rule 6. If the account ever borrows more during the day than allowed, fix it the same day, because repeated violations can restrict the account for 90 days. Housekeeping to close. These mechanics come from FINRA Regulatory Notice 26-10, effective June 4, 2026. Brokers are still rolling the change out through October 2027. So before anyone relies on a single number from today, check exactly how your own broker calculates intraday buying power. Today was an educational walkthrough of the mechanics, nothing more. One more slide before I let you go. Thank you for the time today. Before we wrap, one piece of honest housekeeping. This session was put together by the team at Pixie Trade. Our day job is building a scanner that watches for structure forming in a chart before the breakout happens. Trading has 2 halves: finding the trade and surviving the trade. Today was all about surviving. Finding is the half we left out on purpose. If the session made you curious about that half, the story is at pixietrade.com, and that is the entire pitch, because the sizing rules you just learned work the same whether you ever visit or not. Now here is the part where I ask you for something, and I will be straight about why. If this was useful, the most valuable thing you can send back is not praise, it is a question. Scroll down and tell us which of the 6 rules would be hardest for you to follow, or which slide deserves a full session of its own. We go through every comment, we answer the sharp ones directly, and the best question in this comment section becomes the next video. That is not a slogan, it is literally how we pick topics. And if you are the kind of trader who wants the math before the hype, subscribe. Not for us, for the boring mechanical reason, it is how YouTube knows to hand you the next session, instead of another get-rich-quick thumbnail. One final reminder. Everything today was education, not investment advice, and nothing here was a recommendation to trade on margin or to use any product. The comments are open. What is your question?